In this discussion, we will discuss the discussion question of describe a cost center and how it can be evaluated. When seeing a discussion question or an essay question like this, our goal is typically to expand on our answer as much as possible, as much as the time allows, that allowing us to pick up the most points. Typically, in an essay question, we often get points for things that are in the answer to the essay question and aren't losing points, typically for things that are not in the answer key. In other words, if we have too much information, usually don't lose points. If we have more information that happens to pick up items that they're looking for, then we're going to be picking up points. And in a discussion form, of course, we want to add more discussion. That's the point of it. So we want to be able to broaden our topic as we discuss these items. So let's go through this again. Describe a cost center and how it can be evaluated. The first thing we might want to discuss is the fact that we are talking about managerial accounting as opposed to financial accounting when considering a cost center. So especially for discussion form, that's one way we can take a step back and say, well, this is a managerial accounting concept, and let's talk about managerial accounting as opposed to financial accounting being geared towards decision making, being geared towards a decision about internal decision making, typically breaking the company up into segments, as opposed to financial accounting for external users, typically for the idea being that we're going to have the company as a whole being represented. And then we can go into the cost center and breaking up the company in different types of centers in order to help us evaluate how those centers are doing. This is one approach for managerial accounting. We can do this by listing the different types of centers and comparing and contrasting those centers. For example, we have the cost center. We typically have profit centers. We have investment centers. The reason we typically would break them up into those centers is because of the characteristics of those centers and the difference with which we'll have to evaluate those centers, the tools that we will then use to evaluate those centers. So then we can compare and contrast and say, well, what is a cost center? Typically, you would say that it's a cost center as compared to the other types of centers that we have been putting together. The cost centers only have costs with them. They don't have any revenue. So that means that, of course, if we're evaluating a cost center, a part of our company that just is managing costs, of course, those costs are there in order to help generate revenue. That's the point of the company. But that center in and of itself is not generating revenue, and therefore we can't measure them, of course, on the revenue generation. We have to break them out and say, hey, they're a cost center. We need to evaluate the cost center. In order to do that, we have to come up with measurement tools based on the evaluation of the costs. And this is really important, and it's often something that's going to be overlooked sometimes because the company's always going to be really focused, of course, on revenue. And therefore, the people that are managing costs very well and doing their jobs very well on the cost side of things could get overlooked to some degree. And if that were the case, then the costs could start to get out of hand. And what we want to do is, of course, say, hey, this is the cost center. This is important. We need to measure the cost center in relation to what they do and make sure we have appropriate measurement tools for the cost center as opposed to the profit centers. A profit center then is going to have profit and costs typically. So we would measure kind of on the net profit, oftentimes the inflows minus the outflows, the revenues minus the costs. And then an investment center will typically have costs and profits as well, revenue and costs. However, the investment's usually there for longer term investment. We're thinking about longer term horizons, and therefore we break them out different from a profit center so that we can use those longer term measurement tools to evaluate their performance.